Introduction to Financing Small and Medium Enterprises. You will be able to explain the importance of small and medium enterprises, SMEs, illustrate the concepts and characteristics of the SMEs, classify diversity of SMEs and their profitability for banks, explain the different financing options for SMEs. Module 1. Importance of Small and Medium Enterprises, SMEs. Importance of SMEs. Globally, SMEs represent 90% of registered companies worldwide. They contribute to around 46% of the global GDP. They provide 40 to 50% of total employment opportunities. SMEs significantly contribute to individual countries' GDP. In Egypt, SMEs represent around 95% of registered companies. They contribute to around 80% of the GDP. They provide 70 to 75% of total employment opportunities. In addition, they depend on youth as their major source of employment. SMEs are considered the engine for growth. They play a significant role in employment generation. They contribute to achieving the economic development and prosperity on the national level, as well as for companies and individuals, due to the direct impact they have on individuals' lives. The financial institutions and banks are currently targeting this sector for its economic impact, as well as the impact they have for banks' profitability, in addition to the direct effect on enterprise prosperity. Economic indicators supporting the important role of SMEs. At national level, SMEs play a significant role through their contribution in development, poverty alleviation, reducing unemployment. SMEs contribute directly and indirectly in development and poverty alleviation through increase of small enterprises led to increase in GDP. Increasing the average income would improve the standards of living. Creating new opportunities to contribute to solving the unemployment problem. Lower cost of creating job opportunities. SMEs work as feeding industries and distribution channels for larger enterprises, which creates complementaries in activities. Creating new generations of businessmen. Distribution of SMEs activities over the different governorates creates required distribution of activities and social balance. Spreading more enterprises in villages generate diversification of economic activities, resulting in internal community integration that would lessen the independence of external markets. At the project level, offering financing and banking service to SMEs will directly contribute to development and growth of enterprises, enhancing the production technology at the SME level, increasing the number of employees and expanding in complementary activities, production and distribution, production and exporting, manufacturing and retail selling, transforming projects from informal to formal sectors, attracting people to start their own business and hence encouraging entrepreneurship, contributing in the achievement of self-reliance, independence, and self-esteem of business owners. Creation of a sustainable source of income for business owners not dependent on fixed jobs or monthly salaries. Module 2, Concepts and Characteristics of the SMEs. Importance of setting a unified definition for SMEs. A unified definition for SMEs is crucial for the following reasons. Criteria for developing a unified definition of SMEs. Criteria for SME definition: assets, employment, turnover, sales, capital. Criteria for developing a unified definition of SME. Basic concepts about the definition of SMEs. Multidimension. It is based on three criterion: capital, turnover, employees. Inclusive. It covers both existing and newly established enterprises. Flexible. It allows banks to deal with SMEs in the first year of establishment according to set criteria, no financials, other than existing enterprises. Specific. The definition has specified set criteria for classification of both new enterprises, capital, and for existing enterprises, turnover as basic and number of employees as indicative. Unifying data feedback. According to this definition, all information provided to all regulatory bodies and to I-score will be according to said definition. Characteristics of SMEs. The owner is the project manager. Highly depending on personal resources. Reliance on simple administrative structure. Ability to geographical expansion. Close personal communication between the management and business. Traditional business approach. Utilization of simple hand skills. Limited capital needed. Benefiting from local primary materials. Diversification of the industrial structure. Flexibility in dealing with market requirements than larger projects. Ease in marketing products. Capacity to solve economic needs. Difference between large projects and SMEs. SMEs, limited and moderate in investments. More flexibility. Simple administration structure. Independent management of the projects and related only to the project owner. Ownership of the project is titled to one person or few persons. Simple technology. Large projects. Huge investments. Significant self-contribution. Comprehensive detailed feasibility studies. Approved financial statements prepared according to the international and Egyptian accounting. Large guarantees with significant acquisition cost. High technology. Difference between large projects and SMEs. Module 3. Diversity of SMEs and their profitability for banks. The SMEs sector is considered an attractive market for banks due to the following reasons: market changes and international financial crises. Banks need to expand their portfolio while maintaining diversity and reducing risks. Decreasing profit margins from corporate transactions. Increasing investment requirements for retail activities. Great interest in the SME banking service worldwide. Diversity in SME banking services and the profitability to banks. Banking service to the SME have become an attractive sector for banks and a main contributor to banks' profitability due to the following reasons. SMEs are a virgin market not yet saturated nor fully penetrated by any bank in Egypt. Due to the diversity of activities in the SMEs market and its continuous expansion, this sector represents an interesting opportunity for Egyptian banks. Decrease in the profitability of other banking services coupled with high competition in the market has resulted in banks looking for new markets. Government initiatives encouraging banks to finance SMEs have further attracted banks to this sector. SMEs finance is profitable for banks in case of providing a wide variety of banking services for each client, not just one product, to achieve diversity and reduce risks, and hence attain profitability. No dependency on lending activities only, but a complete set of banking products. This requires full understanding of bank employees of the SME sector, its characteristics and needs, particularly needs related to granting credit to this sector. The general rules of credit, financial analysis, and the different financial tools and products, as well as other sources of finance offered by non-banking financial institutions. The SME sector is considered an attractive market for banks due to the following reasons. Module 4. Various tools of financing SMEs. The concept of bank credit and its characteristics. Bank credit is based on two core concepts: trust and confidence. Banks base their relationship with clients on both trust and confidence in order to provide the various business sectors in any legal form with required finance. Banks offer financing to the different sectors in its various forms of size, cost, and mechanisms appropriate to the need of those sectors, whether current and/or investment of a specific future period, short or long term. It is based on agreement between the two parties and in a way that achieves efficient allocation of resources. At the end of the period, the customer fulfills his obligations against return obtained by the bank. Bank credit characteristics. It is a decision based on trust between the two parties, the bank and the client. Based on the available information to the decision maker about the different aspects of the business, the credit decision is taken, dependent on the analysis and speculation based on the current performance of the client. The main source of repayment is the cash flow generated by the project, while guarantees represent a reassurance for payment. It is a continuous and ongoing operation. It is a risk-based decision. No credit decision is risk-free. General rules for financing SMEs. Studying the client's personality, integrity, and willingness to pay granted loans or facilities. This is based on previous dealing with the banking sector, relationship with the suppliers, tax authority and other institutions, personal characteristics. Checking the client's past experience in the field of activity to be funded, which can be verified based on the past performance of the enterprise. Financial ratios such as liquidity ratios are good indicators as well as profitability ratios. Client's managerial capabilities and financial capacity, which can be derived from the historical performance of the enterprise, capital adequacy, return on equity, and return on investment. General circumstances surrounding the profession or activity or special circumstances to which the client's activity is exposed. The activity should be in a growth stage or improvement, not in decline. Market conditions and competitive situation of the client in the market. The client should feel the burden of participation in funding and associated responsibility. The client should feel completely responsible for the risk inherited in the activity and not the financing bank. Therefore, it is a necessity to obtain the guarantees adequate for the required facility value. The types of guarantees provided for SMEs may include any of the following: commercial notes, commercial mortgages, retention of equity, cash guarantees, guarantor of financial adequacy, bailment of use agreements. General rules for financing SMEs. Studying the various stages of bank financing credit cycle: client request for finance, client data collection, market investigation plus bank investigation, client credit analysis, credit decision, fulfillment of documentations and obtaining guarantees, follow-up control. The concept of credit analysis. 1. Analysis of the client management and its development. 2. Industry analysis. 3. Client market position in comparison to peers. 4. Financial analysis including financial ratios. 5. Analysis of major risks and how to handle them. 6. Relationship with banks, if existing, and with other financial institutions. 7. Creditworthiness of the client. 8. Credit decision and recommendation. The elements of credit study. The purpose of having a credit memorandum: introduce a standardized format for credit analysis in the form of credit memorandum to provide the required information in sufficient format to allow the decision maker to take the required decision, to provide sufficient information about the client, positively and negatively, to make an informed decision. It should provide the following information: basic information about the client, size of the client's activity, development of his transactions, and total size of currently required granted facilities. A historical brief about the entity or the client. Management analysis including job structure analysis and experience. Activity analysis, type of service goods delivered and type of products. Market study, including demand and supply and companies' share in the market. Financial analysis, which represents an analysis of 3 budgets. Status of the client's transactions with the banking system. Description of the company's status in recommendation and credit conditions. The elements of credit study. It should also answer the following questions: will the client receive the finance? What is the appropriate finance amount? What is the type of finance to be provided in terms of its nature? What is the type of finance to be provided in terms of its terms? When will he start paying the finance burdens? When will he start paying the finance assets? What is the purpose of the finance? To what extent is the finance resource enough to pay for the subsequent liabilities? What will be the payment periodicity and the installment values? What will be the interest rate and commission? What are the acceptable guarantees? Are there any other conditions to grant the finance? What are the finance provision procedures and controls? Power of granting the finance. Procedures for following up finance. The elements of credit study. It should also answer the following questions: will the client receive the finance? What is the appropriate finance amount? What is the type of finance to be provided in terms of its nature? What is the type of finance to be provided in terms of its terms? When will he start paying the finance burdens? When will he start paying the finance assets? What is the purpose of the finance? To what extent is the finance resource enough to pay for the subsequent liabilities? What will be the payment periodicity and the installment values? What will be the interest rate and commission? What are the acceptable guarantees? Are there any other conditions to grant the finance? What are the finance provision procedures and controls? power of granting the finance, procedures for following up finance. Financing tools provided by the Egyptian banking sector. Bank loans. Loans are the most popular route to gain finance from many companies, especially SMEs. It represents an option to obtain funds for a specific period of time, short, medium, or long. Borrowers must repay the principal amount in addition to interest. Loans are usually paid back in installments, equal or decreasing, according to the agreement with the bank. Loans are usually obtained to finance capital expenditures, purchase of the machinery, but may sometimes be provided to finance working capital. Loan payments are structured according to an agreed upon schedule, which allows borrowers to plan repayment. Overdraft facilities. It is a financing agreement between the bank and the borrower, allowing him to obtain a certain amount reusable. Each payment to the overdraft account decreases the loan automatically, which can subsequently be reused within the loan period and current limit available. Overdrafts can be used anytime in any amount over its term and limit guaranteed. With overdrafts, companies only pay interest on the actual sums they used, and only for the period in which the account is overdrawn. Normally, banks expect the balance on any account with overdraft limit to fluctuate in and out of credit. It is commonly used to finance enterprises' operating expenses. A letter of credit is a letter from a bank guaranteeing that a buyer's payment to a seller to be received on time and for the correct amount. In the event that the buyer is unable to make payment on the purchase, the bank will be required to cover the full or remaining amount of the purchase. Funding a letter of credit. Banks typically require a pledge of securities or cash as collateral for issuing a letter of credit. Banks also collect a fee for service, typically a percentage of the size of the letter of credit. Types of letters of credit. A commercial letter of credit, a revolving letter of credit, a confirmed letter of credit. Letters of guarantee. A letter of guarantee is a typical contract issued by a bank on behalf of a customer who has entered a contract to purchase goods from a supplier or to deliver goods, services, and promises to meet any financial obligation to the supplier in the event of default. These are several types of letter of guarantee. Advance payment guarantee, prepayment bond. To grant against non-delivery of goods, services for which advance has been received from the buyer. Performance guarantee, retention bond. To guarantee against non-performance of contracted obligations by the seller of the good or the provider of the service. Security deposit bid bonds. To guard against failure of the principal to accept the contract as per the terms and conditions laid down in his tender bid. Retention money guarantee. To guard against non-compliance with the terms of the contract of the project executed by the principal. Financing granted from the Islamic banks. SMEs are mostly funded by Islamic banks through Murabaha. Murabaha is the most appropriate Islamic finance method for small enterprises. Islamic banks prefer using Musharaka and Mudaraba for large enterprises. Financing provided by non-banking financial institutions. This sector includes various types of financing institutions such as insurance companies and real estate mortgage companies, but will tackle financing institutions which provide finance in the form of capital participations or loans for SMEs. Factoring companies, financial leasing, venture capital institution, capital market. Factoring companies. Factoring companies finance the operational needs of companies by providing service to the selling company, factoring receivables, enabling the selling company to dispose accounts receivable or client invoices to buyers and securities to the factoring company. The factoring company provide the following services: immediate funding in form of an advance payment up to 90% of the invoice value, where the company redirects liquidity to the company. Guarantees. The factoring company secures a guarantee to pay invoice in case of the buyer's default or repayment delay. And collection. The factoring company collects the invoices from buyers when due against charges. This sector includes various types of financing institutions such
Financial
as
leasing is an
insurance
agreement
companies
contract
and real
whereby
estate
the
mortgage
utilization
companies.
right of a service is a contractual agreement between
Financing guaranteed
two parties upon which a party is entitled a utilization of an asset owned by the other.
financing banking financial institution.
Financial leasing. Financial leasing is an agreement contract whereby the utilization right of a certain asset owned by the leaser is transferred to the user or a leasee during a certain period of time against the agreed upon rental value. In other words, a lease is a contractual agreement between two parties upon which a party is entitled a utilization of an asset owned by the other party against periodic payments, paid during a certain period of time. Financial lease is deemed less complex in requirements than a bank loan, and it takes less time to be obtained.
Financing guaranteed by venture capital institutions. Venture capital institutions provide finance for investment projects with high level of risk but with high potential growth possibilities. Venture capital institutions are interested in startup projects which involve a high degree of risks and a capability of rapid growth. By investing in projects of higher risk, these companies provide financial, technical, and managerial support until those projects overcome reasons of default and become able of generating high yields. At such time, these companies sell their shares, achieving a profit proportionate to the risk they were subject to.
Capital market. The capital market represents a systematic experience which enables a company to obtain a fund by borrowing bonds or capital increase through issuing shares. New York Stock Exchange was established in Egypt for SMEs in October 2007 as a market in which SMEs whose capital ranging between 500,000 EGP and to 25 million EGP are listed. New York Stock Exchange was established to encourage quickly growing SMEs, including family companies in different sectors, to be listed in the stock market. This will allow SMEs to enjoy listing benefits such as increase of the capital and the market value of the company as a result of the demand and supply for their shares.
Course summary. After you have finished the Introduction to Financing SMEs course, you are now able to explain the importance of small and medium enterprises, SMEs, illustrate the concepts and characteristics of SMEs, classify diversity of SMEs and their profitability for banks, Explain the different financing options for SMEs.